All right, this looks like it's working, right?
Yes.
On their Saturday. Welcome aboard. This is very important stuff we're going to go over. And let's see here. All right. All right, so I'm going to review quickly daily oversold and TTF. I know we pretty much go over it every day, but it's also good to do an in-depth dive into it so everyone kind of understands it. And feel free to raise your hand, press the raise your hand button, or ask questions throughout this, and we will answer them. So, all right, so let's start with okay, so this is the daily view SPX. I'm only using SPX because my SPY chart has way too many lines on it from doing support and resistance every day. So I'm not going to be able to show that one. It would be too confusing. But this is the same thing. This is SPX. So as we all know, we just saw the best two week market run in pretty much history of the stock market. This run right here. And all of that was predicated on daily oversold. So if all you did was zero buying until daily oversold for the last approximately 8 months, 9 months, you would have been fine. Because all this time here from July 25 all the way until April 26th, we were stuck in this range right here. So anyone who bought stocks from really all the way over here to anywhere over here in this area made almost no money because the market's been flat for 7 to 8 months. And my thing is, once the market starts hitting new highs and we go on a really solid run, which was this whole run up over here, I don't really buy stocks anymore. I hold what I have, but I don't just keep unlimitedly buying stocks every time we go higher, hoping that the market just continues to make all-time highs forever. Because eventually it's not going to do that. So really, like if you bought stocks anywhere from like in this general area, you were fine. You know, you made money after this big daily oversold dip here. But if you bought stocks anywhere from like September all the way through here, so any of this area here, you really haven't made any money until just now. And the reason why is because the market flattened out. We were overbought for a while, like all up in this area. We had a bunch of Trump stuff going on. We had the Iran war going on. We had the new administration come in. So the last year has, sorry, the Trump came into office over here, but we had the whole tariff run up, and then we had the Iran war going on, and we had just a lot of uncertainty in general, where the market wasn't making any new highs for, the last 6 or 7 months. So once we get in a situation like that, all you have to do is wait for the market to get daily oversold, and that's when you start buying. And you wouldn't have missed out on anything. Like if we're over here and the market goes up another 3 or 4%, you might think to yourself, shit, I'm missing out. This is terrible. I should just start buying the market. But then you buy the market up here and you hold and you hold and you hold. We don't make any new highs. And eventually we have something like this where everything you bought over here is now underwater. and you're red, and then you're going to start panicking and you're going to want to sell your stocks and you're not going to know what to do. Instead, you don't do anything and you just wait for the sell off to happen, and that's when you start buying. So if we look historically over the last, I mean, we can go all the way back to COVID if we want to get crazy here. So the last 6 years, right? We'll map out some stuff. So every one of these green arrows here is daily oversold. So if you look at a 6 year history of the market here, every single time the market gets daily oversold is a buying opportunity. Does it mean that any given individual daily oversold is always the exact bottom? No. Obviously, that's not the case because you can look over here. This is COVID. The first daily oversold we had was all the way up here. Then we bounced, and then we had the real COVID drop. And we were daily oversold from here all the way down to here. But eventually, we bottomed out at daily oversold, and then we went up on this insane 2 year bull run. So daily oversold might not have been the exact bottom, but it was close enough to the bottom that if you started buying, eventually you would have made money. And then we go back and we go to the next one. Market dipped over here, daily oversold. It had a little bounce that failed, daily oversold again, larger bounce, still failed and failed again. I mean, this was 4 daily oversolds before we bottomed out. 1, 2, 3, 4. But eventually it was the bottom. And if you would have bought over here, we went on another approximately 2 year bull run. And then you wait for the next daily oversold. You could have added the dip on any of these, which then resulted in a nice bull run. You could have bought the dip over here, daily oversold, nice bull run, et cetera, et cetera. And then you get the tariff one, which is similar to the COVID one, where the market dips about 8 or 9%. We get daily oversold, but it wasn't the bottom. It bounced. The bounce failed. We fell another 8%, daily oversold, and then we finally got our bottom. And if you bought over here, which I did, you bought in this general area, we had another year-long bull run. Now, we wait for the next one. Iran war starts somewhere around this area. That's why the market kind of flattened out. We wait for a sell-off, daily oversold, start buying, and the market rocketed. Now, we could have done something like this where daily oversold, we go up, and then we go back down, and then we would have been daily oversold again. So what would I have done? Simply bought more here. Then we could have done this. Then we could have done this. Daily oversold. I would have bought more here. At some point, the market is going to do that, and then it's going to do that. It doesn't mean any individual one is going to be the right one, but what it does mean is eventually it's going to happen. And if you look back at history, there's a 100% win rate of that happening all the way back to COVID, even before COVID. No individual dip is guaranteed to be the bottom. That's just how the market works. But eventually it will be the bottom. And then if you catch the bottom, I mean, look at this. So all you have to do is wait for an eventual bottom, or not even wait, just start averaging in. So what I do is something like this. So let's say the market dips. We're over here, all-time high. Before all this, we're at all-time high. Okay. So this is an all-time high. Now, what I'm doing as the market goes towards all-time highs, I'm decreasing my stock holdings and increasing my cash. So over here, I might have been something like 50-50 cash stocks. By the time we get down to here, I'll be something more like 60-40 stocks cash. By the time we get down here, I'll be 70-30 stocks cash. By the time we get down here, I'd be 80-20 stocks cash, et cetera, et cetera, et cetera, until the market goes down so much that I would eventually be 100% cash or 100% stocks. That it's rare that that happens. We would need something like a 25 to 30% drop in the market for that to happen. But it does happen. The tariff dip was 25%. The COVID dip was 25%. On drops like that, I get very close to like 80-20 cash or 90-10 stocks cash. Only because all you have to do is average in as the market goes down. You don't ever do something where, like, if you're holding, let's say, $10,000 in cash, just because we're daily oversold doesn't mean you're putting in $10,000 over here. You might put in 3,000 of your $10,000 on the first daily oversold. Then you would, on the next daily oversold, let's say we go up and it fails and we go daily oversold again. Then you would put another $3,000 in at this daily oversold. And then we would go to the next daily over, like it goes up again and it fails. You put another $3,000 in on the third daily oversold, et cetera, et cetera, et cetera, all the way down the line until eventually the market bottoms out. And then if the market never bottoms out, then that just means everyone's losing money and the economy's broken and the world's falling apart. And this is going to be the least of our worries anyway. Like if we're in a situation where the market legitimately goes to zero, we have much bigger problems than what the price of the market is. That means that there was like some type of nuclear war, or, there's a financial crisis and the dollar is worthless and we're living in bunkers and shit. That's the only reason the market would ever go down like 90 or 80%. A run of the mill crisis, we might see 25%, which was COVID and the tariff dip. We might see in an extreme scenario 30 to 40%. I can't really think of something where we would see 50%. That would have to be something really bad. And then beyond 50%, we're talking about, global nuclear war or, total economic collapse. So that's how I handle stock market dip buying. And that's the safest way to do it. I never buy all-time highs ever. And does that mean maybe like if someone is buying, like if the market hits all-time high over here and then someone buys this dip with all their money and then it goes up to here, did that person make a lot of money? Of course, it worked out well for you. It worked out great. I'm not saying never to do it, but it's certainly riskier buying the first daily oversold over here, something like this example, where yes, we hit daily oversold, and let's say someone isn't listening to my risk management advice and they put 100% of their money in over here on the first daily oversold. The market bounces 3 or 4%, but then it falls another 10%. And now you have no money to buy the dip. So I always like to scale into the market, and it's worked out really well for me over the last 6 or 7 years. And I've tripled my money in about 5 years, 6 years. I went from just starting to invest around COVID to now 3xing my money in 6 years just by buying the dip, doing nothing else but buying the dip. You buy the dip, you ride the market up, you slowly take money off the table as the market makes new highs, you build your cash pile, you put all your savings into your brokerage account, whatever you can afford to put in, you build the cash, and then the next time the market gets oversold, you start deploying that cash. And then you wait for the market to make another new high and you start taking profit. And then you do the same process over and over and over again throughout your entire investing career. And that's all I've done. So the bottom of COVID when I was buying, SPX was 2,400. Now SPX is 7,200. So that's almost a 2 or 3x on SPX SPY in 6 years. But because I've bought the dips every single time it's gone down, it gives you an extra 20 to 30% over the course of the next, over the course of the last 3 years. So I'm 3x while the market's only 2x because I've bought all the dips along the way instead of buying the highs. Does anyone not understand this concept, or does anyone need clarification on this concept before we move on? Is this pretty clear? I think it's probably one of the more simple strategies you could possibly have. There's really not much to it. You just have to be patient. You have to have the fortitude to buy as it's going down. You can't say, well, the market's going down, I'm going to wait. Well, the market's going down, I'm going to wait. I think it's going to go down more, I'm going to wait. If the market is oversold, you start to put money to work. You can put as little or as much as you want, but the more you put in quicker, the higher the risk. The more you spread your money out, the longer it'll last you, and the more the market can go down before you run out of money. Markets start going down all-time high. Yeah, so if the market goes down from all-time high, you can start buying, but it has to be daily oversold. You don't do that, you don't buy just because the market, we're at all-time high over here, and we had like a 2% dip over here. Well, just because the market's down 2%, I'm not going to start throwing money into the market. That's not enough for me to get interested in buying the dip. I need the market to be daily oversold. That's when I start throwing money into the market. If we were to do something like we would have dipped over here and then this never happened and the market just did this. Let's say this whole thing never happened and all we did was this tiny little dip over here and then we rocketed. I would have missed it. I would not have bought that and I would not have had any additional money into the market. That's just the way that I invest. It's not enough of a dip for me to get interested. Now, does that occasionally work? Like, let's see over here, right? Like this little tiny dip over here was maybe like a 1.5% dip. If someone said, oh, well, I'm going to buy the dip anytime the market dips and they threw all their money in over here. I mean, yeah, like you would have made money because the market continued to go up, but I was already in over here. So why would I buy the market over here if I already have my money in over here? I'm talking about dips that look more like this. This type of dip or this type of dip. That's where I get interested. I don't buy dips that are just like this little thing over here. This one was okay. It wasn't really what I was looking for. No daily oversold. And then we finally got it. And then look at what happened. The day after we got daily oversold, the market was daily oversold for like 2 days. This candle and this candle. And then right after that, we had the biggest run in the history of the stock market. So what you do is you start throwing money in over here on the first day of daily oversold. Then you got one more day. You threw more money in over there. Now you have some money in over here at the exact bottom. And you're up. Every single name I mentioned to buy in this general area, we're up on. Meta, Microsoft, Amazon, Dell, Netflix, Google, SPY, Qs. I don't know. Name some other ones that we bought. But every single thing that I bought, Baba was another one. I'm green on. I'm green on every single swing play that I have. Every single share that I bought, every single swing that I have, they're all green because I was buying down here. And was the news bad? Was everyone saying boots on the ground? Was everyone saying the market's going to go much further? The oil is up, the economy's going to crash? Yeah, that's what everyone was saying, but that doesn't matter to me. Every time people start saying that type of stuff, it never materializes. The tariffs were supposed to be the end of the economy. We were never going to recover. Guess what? We had one of the biggest bull runs in history. COVID, the world was ending. We were never going to have normal life again. The economy was over. one of the biggest bull runs in history. Every single calamity never materializes to the level that people say it's going to materialize to. I ignore the news. I don't listen to the news. And it's served me extremely well. If it didn't work, I wouldn't be doing this. If I didn't listen to the news and I was ignoring the news, and every time I bought one of these things, the market went 20% lower and I'm broke, obviously you guys wouldn't be listening to me. I wouldn't be where I am today. But that's not how it works. The market gets oversold, people step in and start buying. It's just how it works every time. Once again, I'm not saying every single daily oversold is the exact bottom, but it gets you in damn near the bottom. And that's the goal. All right, so let's see. Let's answer some questions here. Has the market ever not bounced up from daily oversold? Well, you tell me. The market's at all-time high right now. So how is it possible that the market would never have bounced? We're at the highest level the market's ever been. So obviously it has to be bouncing from wherever it came from. You can't have a market that's at all-time high and didn't bounce. You know, the math don't math. So even if it didn't bounce at the exact bottom, where it bounced eventually. So, like I said, daily oversold here, and then it still went down another 8 to 10% after daily oversold. But all that means is you buy more on the next daily oversold. And then you buy more on the next daily oversold, and et cetera, et cetera, et cetera, until you're literally out of money. If this wasn't the bottom, I would have bought the market for months until I was literally out of money. If the market, this was an 8% dip, we could have bounced 2 or 3% and went down another 8%. I would have bought more. We could have then bounced 3 or 4% and went down another 8%. I would have bought more. Eventually, I would have kept doing that until either the market is at zero or I was out of money. That's just how it goes. Let's see what else we got. When do I start peeling money off? Okay, so when do I start peeling shares off is totally up to you as an individual. Like this bounce here, I'm starting to peel some off because this is the best bounce in the history of the stock market. And everything that I bought is already up 20, 30, 40%. So mission accomplished. We did what we wanted to do. I just made like 2 years of gains in like 2 weeks. So I'm already starting to peel some off. On this bounce here, once the market got to like maybe somewhere around here, I'm starting to peel some off. Once it got up to here, I'd peel more off. Once it got up to here, I'd peel more off. At some point, I stop peeling because I'm okay with having whatever I have in the market. And usually what that is for me is 50-50, meaning I'm always, with all the money that I have, I'm always at least 50% invested in the market. So if this continues to go up to like something like this, and we're all the way up here and we've never pulled back yet, I'll probably be 50-50 cash stocks. Right now, I'm probably like 65-35. Down here, I was about 70-30. So I've already taken off about 5% of everything that I bought. And I'll take another 5% off over here. And I'll take another 5% up here until I'm back to 50-50. Okay. This is only really for shares. I'm not sure really how to time it with options. Options are riskier. You can try it with options. It doesn't always work. This is for shares. Multi-year bear markets. In all honesty, I mean, we haven't had a multi-year bear market since 2008. So it's been about 12 years or however many years that is, 18 years since we've had a multi-year bear market. So I don't know. We'll have to see how that happens in the future, but it hasn't happened yet. If you like stocks, can you play options on it? Yeah, you can definitely play options. You can do options oh, that was Corgis. Did you get into trades individuals? Yeah, so we can do individual stocks on daily oversold. That works just as well. Let's look at a couple of them really quick. This is Google, daily oversold. Obviously, that worked out really well. Go back in time. Daily oversold, daily oversold, daily oversold. Buying, buying, buying. Huge run. Daily oversold, daily oversold, daily oversold. Average, average, average. Nice bull run there. All these arrows, well, not that one, but all these arrows are daily oversold. Daily oversold, big run. Daily oversold, big run. All this was daily oversold here. Eventually ran big. Okay, you wouldn't want a daily oversold stocks in the market is no. No, it's so buying daily oversold stocks when the market is overheated is not necessarily bad because let's say we're in a bull market, but for whatever reason, an individual stock gets daily oversold because it had either bad earnings or bad news or whatever. You can certainly buy it. That's not a problem, but you only really want to buy it if we're in a good sector, whether that's AI or drones or energy or whatever. You don't want to just buy a random stock because it's daily oversold. But if you want to buy a good stock that just happens to get oversold in the context of a bull market, that's okay. Because typically that market's going to go, or that stock's going to go back up. Yes, you can take a leap on daily oversold. It's still all based on averaging in. So if you want to do options on this instead of shares, that's okay, but that doesn't mean go in with 10 options on the first daily oversold. That means go in on one option on the first daily oversold, then go in on two options on the next daily oversold, then maybe take three on the next daily oversold. The concept is the same. You have to average in. You can never go all in at any given time. As long as you can follow that rule, there's almost no way to lose because the market will bottom before you run out of money. And actually, for me, the lower the market, it's good and it's bad. The lower the market goes, the more money I'll get in, but it means that eventually it has to turn around, or I'm going to lose more money if it doesn't turn around. Like if the market goes down 10%, and all my cash, I have 30% of my cash in, and then it goes down another 10%, and then I have 100% of my cash in, and then it goes down another 10%. Well, that sucks. But if it goes down 10% and I have 20% of my cash in, then it goes down another 10% and I have 50% of all my cash in, and then it goes down another 10%, I have 100% of my cash in, then it turns around. That's great because now I have maximum exposure to the market and the market will turn around and I'll make the maximum amount of money because I'm all in. But if I was to go all in and it doesn't turn around, well, now I'm kind of in trouble. But there's no way to know how far the market's going to go down. So you just have to average in as you go lower. So a quick example of that, and then this will be the last thing, unless there's some specific questions, is we look at a time where there was multiple daily oversolds, right? So this little period right here was the 2023 kind of run. Oh no, here, this one's actually better. This was the 2022 inflation bear market when inflation was at like 9% and everyone was freaking out. So the way I handled this one, and this is a good example of why you can't go all in at once, because let's say everything's going well and the market's going up and we hit daily oversold. Someone says to me, all right, well, Ben said daily oversold. I'm going to throw all my money in right here, right? 100% in. Well, guess what? The market went way lower than that. The market fell from 43 to 35. So it fell another eight, 8 points from here to here. So how I handle dip buying is, let's say I have I have 50% of my cash up here. I'll do, of all my cash, I'll do 10% over here on the first daily oversold. Then on the next big drop, over here, I'll do another 10%. Then on the next big drop, I'll do 20%. So I've used up 50% of all of my cash, and we're down over here. Now the market goes down again. I'll put another 30% over here. So that's 30, 40, 50, 60, 70% of my cash is already in. And then I'll do a final 30% over here on the next daily oversold. So now I'm 100% invested by the time we get down here. And the important thing is, if you guys see, I go lighter earlier. So 10%, 10%, I have 20% of my cash in over here. I have 40% of my cash in over here. I still have 60% of my cash on the sideline. Now the bigger buys are all down here because we're going lower. So I'm getting more of my money in at lower prices because you start slower and increase as time goes on. That way, the lower the market goes, the better the average you're getting. If you flip this around, it's terrible because you have most of your cash in up here and you only get a little bit of your cash in down here. That's not how I want to do it. I want the opposite. I want less of my cash in up here and more of my cash in down here. And then the market proceeded to go after this about a year bear market. We had another 3-year bull market. Right. And then by the time that I get up, well, there was another opportunity to add over here. But by the time we got up to here, I was already out of a lot of the cash that I bought down here. And I repeated the process, right? So I was 50-50 cash back up here. I threw, this dip was pretty big. So let's say I put in 20 of my cash in over here. And then I threw another 30% of all my cash in over here. So of all the cash that I was holding on to, I threw 50% of it back into the market by the time we were down to here. So would it have been better if I threw 100% of my cash in over here? Of course, but there's no way to know how low the market's going to go. Because if I threw all my cash in over here and the market did this instead of this, well, then I would have had no more cash to buy over here. But it went back up, and great. I threw in 50% of all my cash all the way down here. I made a ton of money as the market went up. And even if the market didn't go up, I would have still had a ton of money to add more down here. I would have thrown in another 30% down here. So it's a win-win situation. You're just setting yourself up to, no matter what direction the market goes, always be able to make money. That's it. That's all it is. That's all daily oversold is. Never buying the top, always buying the dip, buying more of the dip the lower it goes, and staying patient and waiting. That's it. That's all there is to it. That's all I've done for the last 6 years watching the market, and it has made me a ton of money. From here, the COVID bottom, which is over here. Oh, wait, no. Over here. From here to here, I've tripled my money in the stock market in 6 years. Just by doing this strategy. Every time the market goes down, you buy. Bought COVID. I bought the bear market, the inflation market. I bought the tariff dip, and then I bought the Iran dip. And you better believe the next dip that happens, no matter what causes it, I'll be buying that one too. All right, let's see. Again, options, I would say you would do about probably a year out, and you start small. You buy one contract, then it dips again. You buy 2 contracts, then it dips again. You buy 3 contracts, et cetera, et cetera, et cetera, all the way down the line. Once again, it depends how much money you have. It depends how much cash you have. It depends how risky you want to be. The more cash you have, the more you can start with, the earlier you can go in, the more contracts you can buy. The less cash you have, the longer you have to wait, the fewer contracts you take, et cetera, et cetera, et cetera. starting slow, increasing over time. Dollar cost averaging to my 401k is fine, but not having some cash or bonds on the side. Yeah. You can average in at all-time high if you want, or have like a set plan where all you're doing is just buying the market at set intervals over time. That's fine and that works because the market once again is at all-time high. So you're not missing anything. But if you maximize the buying at on dips, I think you would outperform someone who just constantly buys. I think, it's a mathematical equation that I'd have to really study, but I'm outperforming the market by doing only buying on the dip. The market's not up 300% in however long. I'm up about 300 something percent. So, all right, next question. How do you deal with underexposure and FOMO? Underexposure and FOMO is what it is. Like, I didn't get in. Would I have loved to have gotten 100% of my cash in over here and caught the dip, the best rip in history with all my cash? Of course I would have. No, there's no excuse, there's no way I can act like I wouldn't have wanted all my money in here, but there's just no way to know. That's just life. I'm not gonna sit here and beat myself up about only putting in, 20 or 30% of my cash over here instead of 100%, because there's no way to know. There's absolutely no way to know. This Putting 100% in over here and catching this would have been the exact opposite of putting in 100% of your cash in over here and then getting slammed by this moving down over here. So over time, I guess it would just even out. If you're in 100% here, you would have taken this whole part here as a loss versus 100% here, and you would have taken all of this as a win. It kind of just balances out. But as long as you stick to the plan, you're making money. It's like if you're upset about making money because you could have made more money, that's called greed. I'm okay making whatever money I made on getting in over here with whatever I got in, because that's how life works. For underexposure, yeah. So you want to choose specific sectors too. I don't just you can buy indexes and not worry about sectors. Like you can buy Qs, SPX, SPY, whatever you want to buy, and it'll just go up. That's fine. I personally buy specific sectors: AI, energy, drones, etc. When do you start peeling off? I start peeling off incrementally. So it's the exact opposite. So if I got, let's say I put in 30% of my cash in over here. Of that 30%, so I might take 10% of that off up here. And then if the market goes up to here, I'll take another 10% off here. And then by the time the market gets up to here, I'll be, of that 30%, I'll be out. All of it will be out. And then I'll be back to 50-50. And I'll just repeat the process the next time the market fails. Or the next time the market falls. That's up to you. I can't tell everyone, like, you guys got to understand, like, us shot callers are only human. Like, I can't necessarily say, get in with the exact right amount of money here, get out with the exact right amount of money there, do this, do that, et cetera, and always be right. All I can say is I have strategies that tend to work over time, and you do what's comfortable for you. Someone might not want to put 30% cash over here. They might only want to put 10% of their cash over here. Someone might not want to take 10% out over here. They might want to take 30% out over here, or take none of it off. Some of these decisions come down to you as an individual and what you want to do with your cash. All I can say is buying the dip incrementally down, eventually you'll make money on it. What you want to do with your names from there is up to you. Like, again, I'm already taking profits on a lot of the names I already bought. I took some off of Google. I took some off of Meta. I took some off of Oracle. I took some off of what was another big one that we hit? Oil. I was short oil. I took some off of that. So it's totally up to you when you want to start taking profits. All I can tell you is when to really start getting in. Beyond that is up to you. Yes, MU. I did start taking some profits on MU as well. MU's had a massive, same exact thing. MU daily oversold and it had a major rip. I'm already taking some back to double top all time high. I'm already taking some off. The higher it goes, the more I take off. Then I get back to being 50-50 cash stocks. I sit, I wait. If the market keeps going up, I make money on the 50% that's in. Eventually, the market comes down. I put the 50% cash that I'm holding back into the market. Repeat, rinse and repeat for your entire life. So that's daily oversold. It's as simple as it gets. It's the simplest strategy on the market. There's nothing to it. You can look at individual names. Anyone can put any name in the chat. We can look at it really, really quickly before we move on to Corgi. But it works for almost everything. Think about a stock you bought in the past that you've taken a loss on. Pull it up on daily oversold. See what you could have done better, and when you should have bought versus when you bought, and see how well it would have worked based on daily oversold. And your jaw will drop. You'll be absolutely shocked, and you'll never go back to buying a stock ever again outside of daily oversold. Palantir, amazing example. I've already mapped this one out. Look at Palantir daily oversold. You would have gotten in over here at $7. You would have gotten in over here at $7. You would have gotten in over here at $16. You would have gotten in over here at $24. You would have gotten in over here anywhere from 140 to 130. It's already back up to 160. I mean, Palantir is one of the best in the ever to play the game. Look, these daily oversolds are all the way down over here. And Palantir, the last daily oversold in Palantir was $25. It didn't get daily oversold again until 130 2 years later. Palantir hasn't been daily oversold in almost 2 years. And you could have just rode it all the way up from the prior daily oversold. Baba, we're already in Baba. Baba, we already bought. I alerted Baba a while ago, and I'm big green on Baba. So Baba daily oversold over here, about 130. I think my alert was around 131 or 130. Then it went up to 138. Then it fell again. I added more on the next daily oversold, 122, 120, and now it's already all the way back up to 142. So this is the good example, right? Daily oversold. You buy it 131, 130. It pops up, but then it has bad earnings. It falls back down into daily oversold. What do I do? Okay, who cares? I bought more. So now I have buys at 130 and I have buys around 122. Who cares? It's at 150, almost 145 now. And then if it would have went down again, I would have bought more. It's so simple. So up, down, up, slightly down. It could have went like that. Would have been daily oversold again. I would have bought more. And then it would have just done this at a later date. As long as it's a good name, you're okay. Now, if you're doing this on a random penny stock or some name I've never heard of, well, I don't know what it's going to do. Don't come crying to me if you buy, some random pharmaceutical stock at daily oversold and it goes down more. That's not what I'm talking about. I'm talking about indexes, blue chips, mega caps, Palantirs, high interest sectors, drones, AI, something in a good sector. Don't come crying to me because you bought Chipotle at daily oversold. Who cares? Chipotle is garbage. Who cares about Chipotle? It's a burrito company. ONDS. Yeah, ONDS is another good example. It worked. ONDS, the last daily oversold was all the way down here. Hasn't been daily oversold since. You would have gotten in at 50 cents. Thing is at $15 now. The next time it even came close was over here. $5. It's at $15 now. NVIDIA, another good example. Last time Nvidia was daily oversold, 107.92. It's at 200 now. The time prior to that, 96. The time prior to that, Jesus Christ, $13. Nvidia hasn't been daily oversold in over a year. And then the time before that, it wasn't daily oversold for almost 2 years, 3 years. That's why when these names get daily oversold, especially if they're good ones, you have to buy them. Just start buying. Whether it's one share, two shares, $100, $200, who cares? Just start buying somewhere. You got to start somewhere. Any other specific names? If not, we'll turn it over to Corgi. Think about any name you've lost money on. Put it in the chat and we'll go over it really quick. Any name you've lost money on that you panic sold or that you tried to buy, didn't work out, and then applied daily oversold to it and see what would have happened. Yeah, well, Weeble's a pain in the ass. Okay, so Pan W and pretty much all the software stuff, it would have worked a couple times, but software is a sector that I'm not interested in. So this one is tough. Like software, I don't care about. So I wouldn't necessarily apply daily oversold to software because it's not in the right sector, but it would have worked a couple times. Like this one worked really well. This one worked really well. This one worked really well. All of these worked, right? You look back, all of these worked. Any of these buys you were green on at some point, even this one. You know, this one kind of failed a bit, but this one was great. All over here was great. NVO, that's pharmaceutical. I don't trade pharmaceuticals. Netflix worked great. Netflix worked amazing. Netflix was one that we did recently. Netflix was daily oversold. I mean, all the way from here, all down here. So you could have, and I've been over this one with a lot of people. That's why I have these markings here. So you buy here with a little bit of money. You buy over here with some more money, some more, and then look at this. Look at this rip. So Netflix went from 74 at the bottom before earnings yesterday to 108. So it's up like 40%, 50% from the bottom. So as long as you were averaging over here, taking averages, you would have eventually got out green. You could have sold it, you could hold it, you could do whatever you want to do. But this for me was a great trade. I'm up like 30% on Netflix because I was buying it down over here. So that was a great trade. The earnings definitely screwed me over pretty good. I gave back, 10% or 9.5% of my Netflix gains. I was up about 40% on it. Now I'm only up about 30% on it. But this is a great example. This worked great. Photonics, it worked. I would say a daily oversold bounce also depends on the name because like a Google or a Meta might not bounce as much as like a Palantir or a smaller company. But I would say a really good oversold bounce is anywhere from 15 to 30%. Some of them go more. Some of them go 50, 60%. Okay. Any other questions? I just like the look of Heikin-Ashi candles better. For me, it's easier to see. It's easier to read. It's more sensitive to daily RSI. Heikin-Ashi is more sensitive to RSI strategies. Regular candles don't work as well. Apple I like. I'm holding Apple long term. Oh, that's not Apple. Apple, I was buying daily oversold all over here. We're already above that. You take a buy, one buy over here on Apple, daily oversold. You buy more down over here, daily oversold. It goes up, comes back down, holds support, goes back up. Um, I don't really change many settings. This is just daily time frame with RSI. That's it. All right. Any other questions? Everyone, I hope understands this. It's pretty much the simplest, safest strategy that exists. There's nothing safer and easier to follow than this. Everyone should be able to grasp this concept. If you're investing and trading in the market and you can't grasp this concept, you have a lot of work to do. This is as simple gets. All right. And TTF, that's a whole different thing. That's day trading. That's ODT options. That's riskier. I don't think we have to get into that right now. That could take another hour, but that's a whole different day trading thing. We can go over that in the future. But the 90% of my money comes from long-term daily oversold dip buying investing. And for 90% of us, that should be your number one focus. It's not as sexy, it's not as quick as making 1,000% on an options play, but I've tripled my net worth in 6 years by just doing daily oversold long-term investing. And everyone can do it. You don't have to, you can have a desk job, you could have a day job, you could be not even watching the market day to day and still do daily oversold. It's the easiest, safest, least amount of effort, and it's amazing. So the more volatile and the weaker the name, the more daily oversold it has to be. So something like MicroStrategy, that's a good one. I'm not going in on the first daily oversold. I'll go in on maybe the second or the third one. Like, MicroStrategy had this insane dip, right? MicroStrategy fell like 60% or something insane. 455 to 113. So it fell like 60%. On any name that has a history of doing just ridiculous things, that's at the whim of like Bitcoin or whatever, I'm not taking the first daily oversold. I'll probably take the second or the third one. So I would have ignored this one all over here. I would have ignored it, and I would have maybe started getting in on this one, or even like this area down here. And it still would have been very, very, very wrong. I would have had to have averaged down all the way from like 240 all the way down to 100, which most people aren't willing to do. But if you were willing to stick with it, MicroStrategy went from 104 all the way back already up to 170 or 160. So it's up 60%. The bigger the drop, the bigger the eventual bounce, but the shittier the name, the more risk there is to the downside. Microsoft, Google, Nvidia, Meta, they're not falling 40, 50, 60%. I mean, it's possible, but it's super rare. A name like MicroStrategy or Coin or Mara or any shittier name, SoFi, Webull, those things can all fall 50, 60%, no problem. I would not put those in high quality name category. Those are low quality. They work, but they're not as safe. Correct. The shittier the name, the smaller you start. Like I would literally throw like $500 over here. And then by the time I'm down to here, I'd be up to like 1,000. And then by the time I'm down to here, I'd be at like 2,000 or 3,000. I'm not throwing 10,000, 20,000, 30,000, etc. You got to start slower, the shittier the name. All right. I will turn it over to Corgi pending no more questions. No, I don't use volume shelves. I don't use volume. I use RSI, support and resistance. So like for this one, right? MicroStrategy, you identify support areas, big support here, support here. So I would have maybe bought some on this one over here, and then I would have waited to buy some until we were down over here because there's a lot of support there. But I don't use volume. I don't use, a million other crazy terms you guys hear on the market. Support, resistance, daily oversold. That's it. You could add some trend lines in too if you want. Like something like that, if you would have wanted to do that, or something forms a really good trend for in the long run, you can try some trend lines, but that's it. A shitty company, yeah. A shitty company more based on price action. Like, I don't know the fundamentals of MicroStrategy. I just know it's not a good company. All it does is hoard Bitcoin. They buy and hoard Bitcoin. There's no fundamentals to it. There's no backstory to it. It's not an AI name. It's not it doesn't produce anything. It hoards and holds Bitcoin. It's a piece of shit company. Webull is a brand new brokerage, relatively new, not tested. It just IPO'd. I'm not going to risk a lot of, I got stuck in that one because it went down so much. SoFi, small cap, crappy finance company. Affirm. I don't know, name some other ones that we trade that are crappy. What's ABTS? I don't even know what that is. Basically, anything that's not a mega cap, established name is a crappy company. Most stocks in the market are crappy. It just is what it is. If you're not in the right sector, you're not in the right, you're not a well-known name. Most of them are crappy. Yes, AAOI would have been a crappy company. They have a historic run going on right now that you would never have ever been able to predict. It is what it is. It's up, 700% in like less than a year. But in the past, it's a piece of junk. AAOI, look at this. Look at AAOI over the course of the last 6 or 7 years. It's done nothing. It's a piece of crap company. But if you bought daily oversold and AAOI because it's in the AI space, you would have been crushing it. Look at these daily oversolds in AAOI. $13, $10, $20. Now it's 160. So I probably would not have had $20,000 in AAOI like I would have put into Meta, but I would have maybe risked $3,000 or $4,000 on AAOI at daily oversold. And guess what? That $3,000 or $4,000, if you held, is now worth $25,000. But if this was a Meta chart and we're daily oversold, I might throw in, $5,000 to $10,000 right away. Because it's Meta, it's Microsoft, it's Google, it's Amazon. Those are different. Okay. All right. That's about it for me. Pretty full coverage on daily oversold, how to do it, when to do it. And I will hand this over to Corgi. If he's still awake. I might have put Corgi to sleep.
You're good. I'm here.
All right.
All right. Put up my screen. All right. Thank you, Ben.
You got it. Happy to help.
All right. Everyone can see my screen really quick. So this is all about style, how I play. So I know it's impossible to get in on all these strikes. Like, by the time I alerts and you say, hey, by the time I pull up my SPY chart, it's already up. Like, why is that? Like, why does, the answer is I do a lot of these Webull on price premium. And to explain that real quick to everyone. So this is SPY in a nutshell. In the Greek, focus. So you get all these different, implied volatility, volumes, open interest. So volume is what's going on today. Like how many people are buying up this contract, 430, 17,000 contract. Like when you open up, Weibo show you, Robinhood, TOS, they all have it, but Robinhood, you can only see one strike at a time. Weibo, I know it's China, people hate it, but I love it. Open interest is what been held overnight. This is what people are holding overnight. This is what got bought up today. Now, in the grand scheme of things, with the Greeks, you got these delta, gamma, Vega, rho, and all these different things. Like, what does that even mean? Most people just, so with delta, this is all you have really to worry about is theta. Now, delta is for if you play swing, meaning if you decide to swing with me or play any of these long-term swing, delta is your, time is your friend. Delta is, let's say the price, let's say you buy Microsoft at 420, 422, and the price stayed the same flat on Monday. You are going to lose this much money per day. This is what you lose for every dollar that it moves. This is how much you make. Either you lose $33 or you lose $33 if the price is, depends on what's going on. For every price drop, this is how much you make. And then theta is SPY. This is where it get kicked in with ODTE. ODTE is horrible. Every day, the price stay the same. So let's say you buy Microsoft 422, and on Monday it stayed the same price. You're gonna lose this much dollar amount. You're gonna lose $43 just for being. Even though you bought at 430, you're gonna lose this much. But even the price stayed flat. So this is how much you make. So let's say it's going up to 423. You make $33, but you lose $43. So in the grand scheme of things, you lost money. And then you got these rho, that's just your interest rate, and then you don't have to worry about too much about Vega and rho. These two, it's not a big thing to worry too much. All you got to worry about is delta and theta. And then gamma, just these two added together. That's how much you make. But theta is always going to be, we always talk about theta on SPY. And I will go to just really much detail on SPY. So delta, for every dollar, it goes up or down. This is how much you make. Theta is how much you lose per day. So when you do swing, buy time. Time is your friend unless you know something, unless you have a momentum breakout. Someone tell you otherwise. Inside informations. You can buy, intra-week. It's best like Costco. We had to buy deep in the money. We hopefully, if it goes up, you need that 3 to 5% pops. If it doesn't move 3 to 5%, theta will eat it up real fast. If you go out to a year out, you see theta, it's insignificant. You lose $7, 7 cents. That's nothing. So that's just why theta is important. And a lot of people usually like to buy deep in the money, so you don't have to get affected by theta or delta, any of that stuff, because this is what's important, theta. Now, for theta, for SPY, price premium, I'm going to show this really quick. And, all right, I can minimize that. So let's say I do the SPY. I'm doing limit price. So I'm using only VWAP. And I'm ignoring EMA, I'm just going to use my EMA. Like when I'm starting out, if I know it's about VWAP, I'm going to take call. Now at VWAP, that's my yellow line right here, which is around, 80 cents, 78 cents. I try to get this call here on Friday, and it was like around, close to $80. this is the price. This is what it looks like on Webull, the price premium. You will see that the yellow line right here, 80 cents, is close to the VWAP. Yes, you can get it underneath, lower, like around 60 cents. That little wick down, around 60 cents. But I know that my VWAP, meaning I'm going to buy just near this VWAP. I know it's going to bounce up from VWAP. If I get it cheaper than 80 cents, I am going to win if it goes up. And now if I add in my EMA, so let's say if I bounce up and you decide to play Webull, now let me go here. I know, just to explain this, so that's why you guys, show you the price premium, how to play it. Like if I was to play this and I want to take 715 call, and I know my VWAP is just yellow line, that if I was to open the market open, it's around 37 cents. I want to take strike, $715 call. And this is your 20 EMA. To weigh it right up, you will see it keep on going up. Let's say I want to buy this at the 20 EMA or at the 50 zone. By looking at either TradingView or at Webull, you say, if I'm going to play using this, when it touched the EMA, the 20 EMA, I'm going to buy back. So I'm going to take a look at this. When it touched back around 50 cents right here, I'm going to buy it. So let's say you miss this. Let's say you miss this move. Like let's say you miss this entire move, and you want to wait for the resistance to come back. You're going to wait to that EMA right here when it touched. So let's say you miss this move. It's like 48 cents. And it goes up to 61 cents. You do not chase. You know this is going to be low and 41 cents. You will never 47 cents, 49 cents. You know that's your bottom price. That is, if it goes underneath, you're in trouble. We are in trouble. So I know it's going to be 49 cents is my price. So I'm going to willing to risk, meaning I'm going to pay around 51 to 49. So my limit price, usually 2 cents or 3 cents above my limit price. So meaning I'm going to risk to buy this at 51 or 52 cents, around, give or take around 3 to 5 cents. Because if I ever see the limit price that when it bottom out here, right here, like I'm playing this when it dips to this 20 EMA, this big red candle, and it touched back and it hits right here. Because I just look to my left and I know, hey, if I hit this 49 cents, that would be an ideal entry. So I always do set my limit price are always about 3 cents above what I'm willing to risk. Meaning if I get down to 49, 48, I'm still in a safe zone. I always do, when I say limit price, I am willing to pay a little bit more than what Webull is showing. 49 cents, the cheapest you can get. So I'm willing to pay 51. That's always my limit price. Now, most people are asking if Corky's getting at 51, what should be my I missed that entry. Can I still chase it? The answer is I do not take profits, and I can show you why. I do not take profit at 5%, 0 DTE. Unless you slap in $1 million, 5% go, unless you slap like $20,000, 5%, yes, you take that profits. But if you have a small port of, let's say, $3,000 to $5,000, you cannot, I repeat, you cannot take profits at 5%. If you have a small port, you have to take profit. The minimum is 20%, 15 to 20% minimum before you scale out. You know, you want the big win, like the 25 to 50% before you scale out. If you scale out at 5%, when you do have a loss, you're going to lose 50% because you have a tendency, all of us have a tendency to hold red play longer, and we sell for profits for peanuts. So if you decided, I'm in at 52, because 49 cents. If I get in at 49 cents, I would never get that. I know that within my range, my limit price is around $3 more than my limit price. So I know that, hey, if I hit the 20 EMA again, it's going to be at around 49 cents. You have time on your hand. It's only good in the first 2 to 3 hours. After lunchtime, the data will affect your play. But if you're early in the day, you have time. You still have within 2 to 3 hours. So this is your limit price. You want to get in close to that 49 cents. I'll be willing to pay 3 cents above 50. If it's at 55, can you still chase? The answer is yes. 3 cents above, I would chase it. Within 5% range, you chase it. Now, when do I take profits? The answer is you want at least a minimum of 20% for me. That's my threshold. That's when I take a deep breath. I either hold it because it can go up higher. The answer is yes, it can go up to 100%. Before that little dip, it goes, because you're a little bit in the money, you have at least an hour to go 100%. Now, the reason I keep saying this is, let's say you have a $10,000 port, right? Let's say you have this much money in your big portfolio. This is your cash account, whatever you have. With BDT being gone away, if you have more than $2,000, I would leave $1,500 for swing, like long-term swing. Like you may take a Palantir, Hood, or Microsoft. Take this long-term swing. Now you have 10 play per day. You never average down. I do not average down. Rarely. You may average maybe once a week or twice a week. I might average 1 or 2 cons down, but I would not. I rarely do that. If I'm in, I'm in. So let's say you take $500 per play. You take $500 per play. Most of the contract that week alerts are, depends on who you follow, but I would always do about $500 per play. You have about 7 to 10 contract. Now your profits are zone where you want to scale out. This is your profit to scale. It's 15 to 50%, not 5%. If you hit 5%, if it's go green, red, you say, oh man, I should have taken my profit at 10%. If you keep thinking like that, you're going to have more red play because your stop loss, because we have a tendency to hold our red play longer. And by the time you see that 35% red, by the time you go to sell, you will be down 40 to 50% red. So if you take $500 per play, your profit to scale is around there. Your average win is around 25%. Let's say you make average 25%. So when do you scale out? Your first play in the day, you scale out 90%. If you have a small portfolio, let's say you have a $2,000 portfolio, same thing, instead of you having more money and more contract, if you have a small port of $2,000, you can only play maybe 3 contract, per play, or 2 contract per play. During the first play of the day, when you hit 20% or around this threshold, like if you get a quick candle that hit 30%, you sell all. When I say scale, you sell all. For me, same thing. When I say I'm scale, I scale out 90% the first play. I know you might see, hey, Corky had that 100% play. Just trust me. This is my runners. I had only 2 contracts. I went really lightly this one. I went with 5 contracts. I sold 4 immediately. I held this one, but this is where I make my money on my second play. Why do I say that? Because your first play, your second play, It's about building your confidence for the day. If you start the day green, the third play, the fourth play, it will get easier. You will win more because the first play, if you win this, you leave your runners. You start out small. The first play, always play small, sell out 90%. If the last contract hit your stop loss, you get out. But if it, or you leave a 10% threshold. The second play is where you make your money. 90%, 80%. And your stop loss, because I you have to willing to sit down because this money you're willing to lose. I keep telling people, if you can't stomach the loss, you're gonna have, because if you take 5% profits here, you're gonna have a bigger loss when you lose. When you do lose, you're gonna lose at your setup. Your goal is to win 8 wins and 2 losses. For me, if I have 2 red plays in a row, I usually stop out and I stop alerting. I give up for the day. I stop trading. So if I lose first play, I'll try again. But if I have 2 losses in a row, I give up. Because let's say you make 100% profits on each of these, 20%. No, not even a lot. But if you win 8 play here, you only make $800 profits. Now for your 2 losses, because you are, you're not willing to take cut easily, because it just decided to give you a nasty red candle, you're gonna lose $400 to $500. At the end of the day, you only care about the end of the day profits. Even at this point, even if you sell, cut your loss at 50%, you are still green for the day at $300 profits. It takes you 8 wins and only 2 losses. That is why I keep telling you, do not take 5%. If you hit 5%, you take a deep breath, you put your phone down, just ignore anything. You have to take profits at this range. All right, that's just a nutshell. Now, okay, so pre-market high, pre-market low. Then when the market open, then to the next step. So when the market open, 30 minutes before the market open, before anything's going on, before you acknowledge this is a news candle. There was data came out. Yes, the data does affect this, but on a normal day, without data, this should be your normal candle. So this is your pre-market high, pre-market low. And then you go to your yesterday charts as well. Yesterday chart meaning you look at where the support, where it was running during regular hours. You don't worry about the pre-market. This is all future trading. You look for the high and look for the low. So this is your support. So if SPY ever go hit back down here on Monday, it's probably going to bounce again, unless there's a catalyst that will kick it down. Then yes, you can take it, go all the way down. But on a regular day, above pre-market high, you go long. So it just came back down to pre-market high. What does it mean? This is a support line. Below this, you take puts. Below this line right here, you take all the way puts. But as long as above this line, above VWAP, is a call. You go long distance. You can add in the orb as well. So with the orb breakout is, the orb is on a 15 and 30 minutes interval. You will notice that's the orb is at the bottom, the pre-market high. So when it breaks after 30 minutes, the market, done, open, you will see this become a support line. So if you miss this, let's say you miss this first move and second move, your next support is, if it break above, you take call. If ever it come back down to the pre-market, to the orb line, and it's become a support, it's going to bounce and it's going to come back up. So here you go. So this was your support. Let's say this is your first move, and you never take the first move. A lot of people usually never play at open, or they wait until at least 45 minutes. Now, how do you play? Like, hey, if you believe in the 20 EMA, you wait for the comeback. Like, you wait. You do not chase this. You do not chase anything above this. Even small cap, you do not chase. You wait for it to come back to the 20 EMA on a red candle. You take it up, or maybe you take the 50 EMA. Some people like the 50 EMA. The 50 EMA on the 5, is the 9 EMA. This is why you don't chase above just, either 5 or the 1 minute. Depends on what you use. I know a lot of people don't like to use the 1 minutes. So this is your support line, and you get in. If you buy call, you want to buy call on a red candle. You do not buy call on a green candle. I know it's scary. And I will show you why. Okay, so here's your 20 EMA. So you will see that it's consolidated this zone right here. Because if you buy on a green candle right here, if you chase the green candle, you are paying for almost $1.50 versus waiting for a red candle. Any red candle on the 20 EMA, you are paying for around 130 versus 150. By the time you get one green candle, you see this red candle, these two identical right here. Right here, it's right here. And then, so you want to buy, because you never possible to catch this, bounce back up. You're going to wait for a retest. Do not, I would always tell people never panic. So it's about patience. If it bounces, you're going to wait for come back in. You want to buy on a small green candle, or when you have a, consolidation zone. When you have a red candle right here, you can ignore this big red candle. It's like, oh my God, it might fall. That's fine. And then you say, all right, I think I'm going to catch this one. It's right here. It's around 130, 135. It's going to take some time before it break out. Like, you just sit on it. Now, I tell people your stop loss should be around 30%. Yep. VWAP is your best friend. It's important. Depends on what EMA you use. You can add in on Webull. You can add in the EMA. I'll close that. The price premium, the VWAP, and the EMA look a little bit different, except for 0DTE. The 0DTE will show a lot more, but on this, if you see the 20 EMA, whenever it touch, if you believe on the EMA, you buy here close to this price. So that's why you have two different screen monitors, and that's why you do not put a stop loss. You are your stop loss. And let's say I want to get in at 162. There might be a period that was at 162, but you're never going to be able to catch that lowest two red candle. So you're willing to pay above, asking price about 3 cents above, or 3 to 5 cents above. So you will be in at 162 is your lowest you're ever going to get. Your limit price is going to be around 3 to 5% above that, which is, sometime for 0DTE, it may be a little bit priced, but for this, it's close to 170. You know that, hey, I'm going to pay 168, 170. Meaning you're gonna want to pay if it's, let's say it hits 187. Do you buy full size at 187? The answer is no. You buy two. You may start out with two contracts. Let's say you decide to chase. You always, if you do chase, you buy two. You wait for the candle to come back down. You wait for this red candle to come back down to close to that 168, 170 zone. And here is where it come back down. Like this is the two candles that you are never going to catch. If it come back down lower than a 20 EMA, because of theta, all of that, that 162, you're never going to catch that. If it does go lower, great. But if it doesn't, so meaning the next red candle come back down close to that 162, you're willing to pay around 35% higher. That's usually my limit price. Because I look to my left, I would not, you're never going to catch that 162. So I'm paying 168, 170. I'm going to get in close to that. I'll do a limit price. If I hit, I'm in. When it does hit that 170, you get that one or two green candle, you automatically be up green again. And how much are you green? Let's say you buy it at 170, right? Or 169, 170. By the time you get two green candle, you're already up $15. You're already up $10 on two small green candle. But do you take profits? Unless you slap 50 to 100 contracts, you take profit. But if you have a small port, you hold it. You do not take profit for 5%. You want the big green candle when you hit 15 to 20, 30%. When we get a quick candle that just pop like this to here, then yes, you can go ahead and scale out. Meaning you hit $200. That's almost $30 right there. $40. That's a 23%, 25%. Because from here to here is 25%. You do not take profit at 5%. Because if you take 5% profits, you're gonna, like I said, your portfolio will never be able to cover for all your losses. So you have a $10,000 port, deuce, leave $15 for swing, long-term swing. The rest is cash every day. So if you do the market decide attack on Monday with the news, you'll be okay. You are not affected by the swing. You're down. You're gonna make money somewhere else. But you're gonna take $500 per play, 7 to 10 contract. You only sell out. This is where you scale. Your average win is gonna be around 25%. Your first play in the day, you can go small, but you sell out, made 90%. You have to scale out super heavy when you hit. It's just to build your confidence. If you start the day green and you have good confidence, you're gonna win. Now, if you have a bigger portfolio, I can go into more detail, but I don't think I want to go into that for today. So this is why I would tell you to take this. Even if you have a 2,000 port, you do 3 contract. The first play, when you hit 20, 30%, you sell out immediately. You just run. You take that money and run. Average down, then get back. Should you sell? Never wait for profit. Correct. So if you let's say you take a play on this play right here. Let's say we bought this call because I bought this call on Friday because I saw this was the first strike, second strike, the third strike. I took this puts right around this area. I'm thinking it's going to keep on going down because it's going to give you one more leg down, like a baseball. So instead, the market took off and I was red. What happened if the market keep going up and you average down? Let's say you put $500 here. And then you add in an extra $500 here. And the market just keep on going. Keep going up higher. You just lost 1,000. The answer is you don't, Ali. You do not. So only thing you can do is if you think it's going to keep on going, you take this play, you move on. You don't wait. You wait for a perfect setup. Like if there's no perfect setup, why would you want to take? say I'm going to take call again. It never broke above this 200 that 100 EMA line. It was above, it was underneath. If it break above, yes, I might have to cut my losses and move on. The answer is you have to have a really high risk tolerance because you never average down. You do not, you either, sometimes you might average only if you have been up so much you don't care about losing more money. Because if you average down and you have no more money left, you might miss the next move, if it keep on going up. Like, let's say you take this puts and you think it's going to keep on going down, but let's say you bought puts right here. Let's say you bought puts right here, you average down and it doesn't go down, it just keep going up. You are going to lose $500, $500, $500. At some point, you're just going to lose too much money. You had to sell out all, and you just lost, versus, what, I'm going to buy puts right here. Let's say I would buy puts right in this area right here. Let's say I buy puts right here. All right. And I buy puts right here and I refuse to take call. Let's say I buy puts in this area and it keep going up and going up. If I've been holding this for like the next 1 hour, I'm like, dang, it's just keep going new high. Like, first, second, third, it just keep going up. I would have sell out and I'll be like, what, I'm just going to take call right here. I would be able to make my money back on this loss right here versus averaging down, averaging down, averaging down, only to lose $1,500 versus, what, I took puts right here. I decided to cut my at 50% loss. I'm down $250. I'm going to take my call here and I make 200. Let's say I make $100 here. I'm still down. Yes, I'm down $150 here, still total. But I just cover half of my loss on this bounce back up here. I'm going to wait for the next set of play. I'm going to wait to see what I can do the next day. If I miss this big move, do not chase. Like, let's say if I want to take put, let's say I want puts, but I completely miss this big drop. Do I chase? The answer is you can have chased at the 20. Always look for a support line, or at least either the 20 or the 50. Those are your two best friends, either calls or puts. That's why I took puts right here. I'm seeing the 20 EMAs, being a resistance. I took puts. Now, the reason I held just because it's the 50, it's all underneath the EMA. I held my puts. When I broke even, I sold it. This is the only time when you do not take any profits. Let's say you bought call and you've been red for 50% for like, good 30 minutes. When you are close to break even, you sell out. You don't worry, you don't average down. You move on. If you do take a loss, you only lost, $250 versus, trying to average it down, trying to break even. That's the wrong mindset because, it can keep on going and you be down a grand easily. I'll be down $700 by the time you start, selling out, because you could have bought back here in the call, you make your money back. So, so that's way. All right, next question. I'm going to down 30% if I want break even, and never so I was waiting for profits. So that is why, and I use a lot of parallel line. And daily oversold is always your best friend as well. Always look to your left and see where the candle is being bounced, like Microsoft. Back here, November 21st, there's a big candle right here. And then, this line right here, June 23rd, a second. I know this is above this. It bounced from here. And the daily oversold, same concept. Like, you don't, let's say you bought call here and it goes down. You went up green, and then shares and options are always two different animals. I didn't think the market would take off this fast, just in a hurry. But the daily oversold hit on this point, and it went over here. You can pick any of the Max 7. They all have similar structures. Probably Google is probably the best stocks of them all. On the daily, you see whenever it touched the bottom of this parallel line, it just bounced straight up. The daily oversold, I think I Yeah, I play Google a lot. That's why I bought Google, but I didn't go big. So here's your above this line. You see how this daily candle is above just right here. And then you got your hammer on this candle right here. You see that big green hammer? It could be a red hammer or a green hammer. It doesn't have to be any color. It just has to be a hammer with the wick at the bottom. Right here, remember I bought on July 7th? It was a green day on Amazon because of the same particular candle, that green hammer with the wick. You see how the wick right here? Yep, it did bounce and then it died. But still, if you play short term or or long term, you are green the next day or two. Depends on how big is the bounce. It's it's up to the market maker. My horizontal line is just my support line. It's just some of my. I look to my left and I see where does all these lines support itself. Like where does it bounce from? Like where does the last, meaning above this line, it's gonna bounce. Like meaning it's become a support line. Underneath, it's become a meaning it's tough to break out again on the daily. So it looks like the FEG zone. So if just above this line right here on the daily, meaning usually you don't take it when it's on the line, on this resistance. Like you do not buy on when you think it's gonna, because it can go down further. It may give you a fake breakout, but if it's underneath, it's just gonna be a bad, it's gonna dump. That yellow line. Let's see me pick a bigger stuff, better stuff. Do I have any charts on this palette here? Okay, I do have some. Okay. Now palette, you see this, you will notice that on here, on February 25th, there is that above yes. Now we have put 1, 2, 3 triple bottom. It can always go lower, yes. Like I said, only strong stock in different sector. And with news, if Trump say, hey, you should buy this stock, the last time we did that with Intel took off, Palantir did the same identical move. Just look to your left and say, is this a good support line? Like this is double, triple bottom. I'm gonna test it out. Yes, I might have this is why, when we started out, why we went small on the Microsoft, the Google, didn't think the market would take off. But when it does take off, when there's news, you can go bigger. And if you decide to follow me and say, hey, which one should I buy? The answer is, I'll give you different size. Now, where is my, let me swing. Okay. I would tell you this is how many contract I have. Versus yes, like yes, I'm saying I'm only buying 2 to 3, meaning I have no confidence in this. This one I'm slapping, take this is $4,000 versus $500. And when there's letters like this, when you add them all up, it's almost $10,000. It's up to you to either do I want to trust this or do I just to take this? Because you can either take all your money. If let's say you have a small port and you don't have the size to buy everything. Sometimes I will show you how many contracts I'm buying. Yes, I'm buying with $10,000, $9,000 all to Palantir. And the same with Google, same with Microsoft or Palantir and Hood. I will show you how many contracts I buy, and versus yes, I don't trust this play. I'm not going to show you how many cons I have. I'm just going to share you. I have like 2 or 3. I have $1,000 per play, but when you have 10,000, it give you a little bit more confidence to say I am going to trust blind faith. Because if I lose, I'm going to lose 3 to 5 grand overnight. And then you say, when do I start scaling? You swing with time. You do not take profit at 30% or 10%, especially when you have time on your hand. Especially like, let's say 2027, June of 2027, that's over a year from now. You only want to sell when you hit 50 to 100. Like if you're short terms, yes, ODT, you take profit immediately. Swing, you have time. You have to say the urge not to take profits. First, the first threshold is around 50%, 30%. You can take one, you can peel one off. If you decide to slap with 5 contract, let's say you buy just with 6, let's say you buy swing with $15 per swing. You can have 6 play, 6 contract. Let's say you take with 6 contract at $250 each. Your profit to scale is around 30 to 50%. That's when you sell out at least 2. You look for the 100. We want the 100 to 200 when you start selling, because if you sell out early, you would never cover for the loss, the P&L. Because when you do have a red play, you could be down 50%. Let's say you swing with $1,500, you could be down $500 to $700 when it goes, against you. Like our threshold is still gonna be around this range. For swing, I go large based on momentum breakout, without news, without anything. I said, hey, buy IBM because earning is coming up. And they had the 3 white soldier patterns. 3 white soldier patterns is always a bullish patterns. You would see this. It's when it's usually 3 identical candle above each other, not like this. It has to be above each one. Create a new candle above this. So you have to have news, momentum. If there's no news, you can't just slap really heavy and think that it's going to keep on going new high. I mean, my value is just a piece on its own. Yeah, I missed this one, but so let's say you buy here on this daily oversold, semi or close to the daily oversold, maybe not on the high-swing candle, but let's say you buy here, and you decide to swing 2 or 3 months out. February. By the time it's April, theta would have eat you up. In this zone right here, when you have a big red candle, would have eat you up. So you can't just slap it just because you think it's going to keep on breaking out. You have to have news. Must have earning. Like right here's earnings coming up. So you could have buy a week before that, and then you sell out, scale out before the earnings coming up. So that's why I bought up IBM last week. I told, hey, buy IBM. The earning is coming up in the next day or 2, in a few days from now. And the calls are already up 50%, 30%, 50%. The answer is yes. I know. I'm always going to look for, I haven't put anything new on Friday because I'm thinking over the weekend the market's going to tank. So I don't want to risk. Monday is where you approach. Weekend, you do not trust the weekend. Monday, you observe what the market do, because I try to short the market on Monday on SPY. Friday, Monday, always observe. Monday is the day you observe what the market's going to do. Monday, the market just never tank. And then Tuesday, I gave up shorting the markets. Like I saw a huge gap on Monday because we always Monday we always have a green Monday, and I try to short it. I'm thinking that, hey, it's just way up, bounce way too hard. I'm thinking I'm going to short it, and then I try to short, take it down. It doesn't work. Same thing with Tuesday and Wednesday. Oops, too many things going on here. But So anyone have any question about this? No, this is a big portfolio if you have that much money. But if you don't, if you have just much, I would only recommend you to swing small size 10,000 in option swing. So, but if you have a smaller size, this is where you want to target here, is around 2,000 point. Now, always look to your left, meaning if the markets keep on going new high, it has to come back down sometime. When it does, it's going to go find yesterday pre-market support line and then bounce back down. So if it does, let's say Monday, we open up in this range, the next support is going to be around 702 for a bounce back up. You know, if it goes down to break down in 702 with bad news, yes, it can go all the way down. How low? I mean, it can go back and find that gap zone. At some point, it's going to find either at around $700, 696 right here. But that's just a different strategy. But anyway, that won't be too much detail. Anyone have any questions? Oh yeah, Tesla. Same thing here. Instead of using the VWAP, I'm using the 200 EMA on Tesla. On Friday, this exact call right here. So this was the price that I trying to get in around 115, because this was when it was right here. So I'm seeing this is like around here. It came back and around support around this 114 line. Yes, it did go down further right in this candle. It dipped down to around under 1. Even this red candle brought it down under 115, because we are out the money. But within 2-hour range, you have time is your friend. Within a 2-hour range, anything out the money, you're still not affected by theta too much. It's only lunchtime when it's exponentially. IBM earnings is on the 28th. So we will see how it does, but see how this price premium, you look at this, like I like the 200 EMA. This is where, let's say you love this stock. You want to play, where do I want to buy? Either the 200, the VWAP, or, pick a EMA. I was looking at the 200 EMA and I draw it out and I say, this is around 115, 114. I'm close to it. I'm going to take it. My stop loss is still going to be around 30%. But it just moved, erratically. But you are never, like I said, Tesla, it went up to over $900 because Tesla Friday or Tesla 0 DTE paid the most. That's why people either love Tesla or they hate Tesla. Because if you do get it right, that one contract can pay for an entire, lost. So if you slap this with, let's say, 5 contract and you don't like it, you can sell out. When it's up 20, 30%, you sell out most of it. You leave the last one. If it doesn't hit, you could have sell out the 500. I sold this at the 500 range, and it go up to over 900 because we were in the money. Like Tesla Friday, just didn't like to move $10, $15 in a day. And you saw what it did on Thursday. Not Thursday, Wednesday. So Wednesday, Tesla moved from 360 to 393. So this was on Wednesday, and what it did is look at that red candle. It's an inside bar move. So most people usually never like to chase on a big green candle the next day. If they do, they wait for what's going on, You see, this is all the volume, like penny stock, same concept. Same concept. They always take, let's say you take this play on just one big move, or let's say you miss this. They're gonna watch this to see what the next daily candle is gonna form. If it's an inside bar move, this is a massive volume here. So this is an inside bar with the hammer, with the wick at the bottom. And when it, and then the next day, this is Friday, it break above this and it break new high. Same concept, like penny stocks of, options. Any stock with volume, we watch the next day because it gave back some of the profits. It consolidate, it formed an inside bar move, and the volume was still there. That's why I really wanted to play it, because of this day right here, this massive day, form an inside bar move. And then I took it on Friday. I know it's a love-hate relationship. See, same concept. Here's that bar move, that hammer. That's why I held it. I'm like, you know what? It has identical candle. It does have a candle, so I'm just gonna hold up. If you decide to trust it, the next day that hood plate, it pops quick. I mean, it's gonna die down. I don't like when the wick is above. This meaning the exhaustion candle. This is buyers are getting exhausted. We might have a little wick down. Hopefully it doesn't wick all the way down. But if it does, we have to, you should be already to be green. This line right here is in the sand. Right here. Like, so this has to be your, so let's say you bought at the top, some point, you're going to have to take a loss if you have short-term play. But if you have long-term, it may come back down to retest at some support, and then it's going to bounce back up. But that's, from 90 to 85, and then bounce back up. That's going to be for hood. But now RSI, if you decide to play the RSI, just the RSI alone, on a normal day, now this was just a momentum breakout. There was no way to know how high can it go. So right here at the bottom when the market opened, this was at the bottom of the at the RSI. So when you place call, you want to buy call at the bottom of the RSI. If it's in between, you do not touch it unless you're looking at the VWAP. Then yes, you can take the call at the VWAP or the 50. But some people only look at the RSI. So you buy call here, meaning right at open. You don't touch this, you ignore all of this. You could attempt one puts right here. Second puts, but this was just a massive breakout. When it being oversold, double top on this zone right here. I mean, there was a mini scalp at puts. This is a bad day to use the RSI. It was impossible to try to, guess puts. On a day when there's no, right now we're in a lockout period. I used the 1 minute and the RSI. I used the RSI for everything, but the 1 minute, I only used the RSI on the 1 minute for SPY to scalp just quickly. So here's the one double top, triple top on the RSI. So this was a bad attempt on puts, second attempt on puts. Eventually you're gonna win on puts. So it's right here. You're like, hey, I'm seeing a triple top puts right here. Even though it dropped a lot, I only make 30% on the puts because it was a slow bleed. And in between, you don't take it again. The same thing over here. Now, this is where you want to take your puts. So if I completely missed this one, I was too busy doing all the stuff. But here, is where you would have, you see this trend down underneath this. This is where I would have taken my puts, but it dropped way too fast. So I just, you know, I miss it. I'm not gonna chase it. But if you're only looking at the RSI and you're only using this RSI on a normal day when there's no huge momentum breakout like Friday, this is where you would take your puts. Like you would take your puts right and just, you know, when it over tests, just touch this. That's right here. You take your puts right here. And you have your 30% stop loss. Some people buy deep in the money. You know, if you do buy deep in the money, you can do with 1 or 2 contract, add in. And so eventually it's going to break below. But if you bought puts on this point when it broke, you know, right here, you need to go down much, you know, time is not your friend. So this is the RSI. When it's being overbought, you take puts, you know, and I will write it down. I'll say, hey, RSI is up to 70. I'm going to attempt a puts. And then here, you see the VWAP. It never lost that VWAP the entire days. Yeah, it did break down below for like a minute or two, and it consolidated and break out. And I just took the call on this zone, you know, for a quick scalp up. 2 big candle. You know, sometimes people like to take it on the second, third candle. I tell you, if you trust your play, buy it on the second candle. Don't wait for the first candle. Don't wait for the third candle confirmations. Because if you buy the top here, your profit is very small. So you want to buy at the limit price. Where is that? I think I have that chart somewhere. Okay. Okay, all good. So here is where I took that. Let's say I took that. I want that call on this zone right here at that 710. See that 163? You're never going to be able to catch that 163. So your limit price is always going to be around, you know, 3 to 5% above this. Depends on, you know, 0 DTE. It will be easier, but this is like 1 DTE. This is a little bit 1 DTE further out. This is on April 20th. So meaning within the 3 to 5% range is around 170. But if 0 DTE is around $2, $3 above the bottom zone. So when I say limit price, I'm usually around 3 cents above my limit to the lowest price. So if it's 160, if it's 63 cents, I'm willing to pay, you know, 65, 68 cents. Since this is $1 more, it's, you know, it's kind of a little bit more dollars. So this is where I bought back in right here. And I took back, you know, that way we get the little bounce. You know, Zenkin, I would never take the third breakout candle. If you trust the play, trust your gut. If you trust this is, hey, this is the bottom VWAP, it's been support this line. It hasn't lost its VWAP all day long. I'm going to take it down to bottom. I'm going to take it on the first, second. I might miss the first, but I'm going to take at the bottom lowest price I can. I'm not going to wait for the breakout to take the call. I'm going to wait for this second candle to break out, like the first candle, 1 minute right after breakout. I'm going to take it. Trust your gut. If you say, I'm going to take call right here, have a stop loss around 30%. You know, stop loss around 30 to, you know, 20%, whatever you have your stop loss at. Just, you know, it can always go lower. Because if you buy this, you already miss all of this profits. So this is why I like to get this in. I missed that first candle, big drop, red candle, and I'm trying to get in. I know 163 I can't buy at the 163. I'm going to buy at this price. So this is my limit price. I'll say I'm in at 58 cents, so 70 cents. Meaning at 70 cents or 72, 73, you get in. By the time it hits up, you're already up, $80, $90. Even though it went up to that few candles in a second, you're already up, from 170 to 190. And same concept over here. We bought it at 58. It hits 90 cents above here. And we are that's a big profits. And you also have, on the 5 minutes, on the 1 minute, you have just bottom right here, 1, 2, triple bottom or double bottom, you want to call it. Remember, double bottom, the market like to bounce. Double bottom, triple bottom, quadruple bottom, it's going to bounce. It's eventually going to bounce. Same thing with double top. If the market double top, it's usually like to reject. Like right here, we see this double top. Right here, I think I took the puts. Quick 30% profit, same concept. If you see it, but if it's consolidations, quadruple top, it's going to break out. Or quadruple bottom, it's going to break down. Same concept. You get test 1, test 2, test 3. By the time the test number 4, it's going to break out. That's what we always have quad. It's like baseball. You have only 3 strike. All right. Anyone have any other questions? So I don't keep rambling talking about nonsense. And make sure if you do trade 0DTE or trade anything, write a journal and then go back the day before and say, why did I take this? If you have a red play, it's fine. I mean, I took puts right here. I'm thinking it's going to drop because I'm thinking it's going to be 1, 2, 3, 4 quadruple bottom. I'm thinking it's going to it has to drop. The market didn't drop. A trend line and chart the best for each. Can you please go over time frame? TTF time frame? Tati? Trend line, I just look for I use the EMA and I just go to my, I just look to yesterday low. I just use the pre-market high, pre-market low. Above pre-market high, I'm going to go call. Underneath pre-market low, we haven't pre-market low in a long time. So during regular hours, this become a support. We haven't lost every single day for the last week. SPY hasn't lost previous day support line or low. It has formed into a support line. 6, 7, 8. There's another one close to around here where it's bounced back up. It's just keep making new highs. 693. 695. There's during this regular hours, I really don't look at this future trading hours. It does not mean anything to me. But I know this is going to be the next one right here. What if we lose 693? We will lose to 682 because this is a big pops. Because this was a big pop overnight. Hash candle is perfectly good on for TTF for smooth candle. Now let's say I'm playing SPY. I like to see my red and green candle. I don't see any red candle on just 1 minute EMA on this 1 minute time frame. So I don't. I only use that 5 minutes for my. If I'm looking for the TTF or if I'm looking for the daily oversold. That's why I have this different, charts right here. I have different, whatever you call it, this different screen, different chart for different. This is my main one that I use. Meaning I would chart all of this on the bigger time frame. I use this for bigger time to find my support, and I'll just is my 0 DTE, and now this is where I do all my journal entry and all my play every single day. And then I have another one where I just to look at, 5 bigs. I might take some notes here and there, but this is my main thing that I look on a daily, on every few weeks or every few days. I go on and look for different stocks to play. And if I decide to see, like, hey, I like Tesla a lot. Where should I buy this, or where should I take my profit on Palantir? Like same concept. So Palantir, same thing. The market opened at this point. I know yesterday above this, I need to take call because on the daily candle, it has that really nice kind of a little bit hammer. It had that perfect hammer, but then it lost it. But so this was when I bought Palantir, same thing. And then I go zoom out and say it's 170, why 170, 147 for 0 DTE call. It's above just right here, always just line on this zone right here. I know there's a little bit wiggle room concept. That little gap right here, that's 147. It does, there was a little gap between these 2 points. On one thin from band. So because the hashing candle under 5, hashing candle, the hashing candle will touch under 5 minutes first before the regular candle hit. If you use regular candle, you would not see this hashing. It would not touch it. So that's the only reason. I think March the TTF never lost except for one. This month is a little bit weird because of the tariff, not the tariff, with Trump and Iran. I think I would let Ben explain to you about that TTF, Trevor, because that's the TTF came from Ben. Ben created this one. Okay, next question is Koki Kindak. From your experience in SPY call puts, what is the average stop loss in motion of your play? The answer is it is 30% for me. I know it's really painful to say it, but yes, it is. It's 30%. Some people don't like it because majority of the time, if you take your loss at 10 to 20%, if you cut yourself at 10 or 20%, you would notice that. Do a journal entry. Don't trade, don't take any trade. Just write journal entry and say, hey, I'm taking this call at this price, at 90 cents. I want to go back here. Let's say I take out the second candle right here, somewhere. No, the market didn't give any red candle at all. That's a bad play. 120. Okay, so I know for SPY, for ODT, if you put yourself at a 30% stop loss, you're gonna get yourself wick out all the time. So let's say I buy this at the 200 EMA around 220, 210. I don't think you're gonna get a 210. I'm saying I'm at the 200 EMA. I'm gonna buy this around 225. Let's say that is my 225. That's what I'm gonna buy it at, and it hit 195. That's a $25 lost or $30 lost. That's almost a 50%. If this was 0 DTE, you pay for 125 and it got down to 225, we go down to 195. That's a $25, $30 loss on this one contract alone. And now you buy 10 contract, that's $300 lost. Because just have to do a journal entry, and you would notice, that's the only way I can explain it, because you have to be willing to accept your loss. Because if you take a play and you think you're going to make money on every single play, you are not going to make, and you say, hey, I'm red 30%, I'm going to cut it. Yes, you should cut it, because by the time you sell the 30%, by the time you go and execute, you'll be down 40% immediately anyway. So you are your stop loss. Just look at the candle. Best, buy the call. Put your phone down. Don't look at it. Don't look at your P&L. Don't look at your hey, my play is down 50%. Yep. So, yeah. So that's why I say my stop loss is around 30 to 35%. By the time the 35% hit, and you go execute, you'll be down 40%. So 5% do not take profit. 10% don't take profits. All right. So Zoo, I have no recession candle. What's the best candle to use for option versus stocks? So to play for anything, I use the regular bar. I play just the regular bar so I can see the 1 minute. If I decide to play on a 1 minute, I want to get in on a red candle. You have to try it out, because if I want to buy SPY call, I want to get in on a red candle. I don't want to buy on a green candle. That's just chasing the momentum breakout. Some people chase the momentum breakout, but you better have, take a profit quickly, because I hate to chase a momentum breaking by in here and to see this red candle. All my profit would be gone. I'd rather buy it on a red candle if I know the momentum is still going to break out. I'll get in cheap, wick in. Yes, they do, because if you look at this and you look at the hashing candle, you didn't see a red candle for a while. There was no red candle until up over here. So any other questions? Yeah, you see, yes, it's no red candle at all until it reached to this point, until it reached to this side. But otherwise, if you want to buy SPY or play 0 DTE, you want to get in on a red candle, on the regular candlesticks. Yep. So this is what I use. This is all I normally use. I don't have to explain, I can go into more, if I was to play by myself, I would be looking at just, you would have a heart attack. I used the orb, and I used the double, not the orb, I used the double box. And I used the FEG a lot. So anyone have any other questions? I'll let you guys have. And if you need help one-on-one or discuss, private matters that you don't want to talk on here, just DM me. I'll spend a few hours with you. Say, hey, I have a $3,000 port, or I have 100,000 or 10,000. What's my best strategy? And if you need me to explain this into more detail on one-on-one, slow down the pace, using the RSI, using, like you're a clean split slate, and you have no idea what's going on in the markets, I can slow down and explain in more details. But that's just a brief snapshot. Just the EMA, VWAP, and how to use the price premium. All right. Thank you for joining me. Hope you have a good weekend. And I'll see you Monday.